Hi, good afternoon. Welcome to the marketplace. Coming up this afternoon, Bank of Ghana Governor Dr. Johnson Esiama warns path to full economic stability is fraught with risk as he justifies push for fresh measures to contain inflation and thirst to growth.
Inflation outlook, while improving, remains vulnerable to second-round effects. Food supply constraints are still with us, especially from northern Ghana and the Sahel.
Also coming up, Ghana Stock Exchange records over 30% growth, emerging as the best securities market in the West African region in the first quarter of 2025.
As of May 18th, the GSE equities market has recorded a very strong performance. Our index was up over 30%, the best in West Africa.
My name is Daryl Kwao. Thanks for being with us. Details coming up. And thanks for staying with us, everyone. Governor of the Bank of Ghana, Dr. Johnson Esiama, is warning that the country is on the path, the country's path to full economic stability is fraught with risk and some complexities. The governor highlighted these issues at the opening of the Monetary Policy Committee meeting.
Inflation outlook, while improving, remains vulnerable to second-round effects. Food supply constraints are still with us, especially from northern Ghana and the Sahel, and external price shocks, particularly given volatile global commodity markets. There are also geopolitical tensions and evolving global trade dynamics, including the recent US-led tariff disputes. These have heightened market uncertainty and could affect commodity prices, could affect exchange rates, and could affect financial flows in emerging markets like ours. In this context, colleagues, the bank has commenced a comprehensive review of its monetary policy implementation framework. We are transitioning from reliance on the unremunerated cash reserve ratio to a more active open market operations regime, including the use of longer tenor BoG instruments, as we announced at the previous MPC, the maiden MPC that I had. This is intended to enhance policy transmission. It is intended to improve liquidity management, and it is intended to allow greater room for credit expansion to the private sector. Colleagues, as we approach our deliberations, we must carefully assess whether the current monetary policy stance remains adequate to drive disinflation without undermining the fragile growth momentum we have currently.
Two of the meetings on Zoom with me, Courage Bouti, Manager, Macroeconomic Research, GCB Bank PLC. Good afternoon to you, Courage. So, how significant are these risks the governor mentions that threaten our path to economic stability? What are we up against, and what resilience do we need to withstand this?
Well, yes, good afternoon, and good afternoon to your listeners. He alluded to price pressures, security issues around the north, global issues like the trade war and what it means for Ghana and all that. I think it dawns on us to do a holistic assessment of what the real impact of this tariff imposition is for Ghana. Thankfully, we are the lower end of the ebb. We got slapped 10%. Doesn't mean negotiation with the US government to take it off. What does it mean for us? There are a few options open to government to explore. One of them includes exploring the aftermarket to see where you could develop new trade routes without having to face tariffs. Another means if we are being charged the least, which other global giants who have suffered a bit more than us would want to pitch camp here and still target the US market if the conditions favor? And how do we attract such people in here? That is also an option. Amid various other options, really, we need to deal with that. We need to deal with the structural issues around food supply that has plagued us for so long and underpin the inflationary run we've seen over the last few months and years, really. How do we do that? Yes, government policy is one, and we've had some in the budget and then in the lead up to the elections and all that. But we also know the structural impediments to implementing some of those policies. The rain dependence is still an issue. The subsistence farming is still an issue. The low commercialization in farming is still an issue. Warehousing, storage, and stuff like that, and enhancing the value chain, even the transport arrangement to get food from the farm gate to the prices are still issues and are part of the reasons why food prices are very high. And so we need to holistically deal with those issues to ensure that inflation is downward. We've seen exchange rate kind of correct sharply in the last few weeks and month ahead or behind us also. What are the key drivers? Have we ascertained them? You've heard the political argument as to what is causing and not causing it, but we need to properly diagnose what the triggers are and how we can anchor it, and then we can reduce our vulnerability to FX changes and all that. So those are, I believe, the critical questions they must answer the MPC and lay the policy marker for the rest of the economy to follow. I don't think we are doing badly. We need to be deliberate and anchor the gains we are making and then build on them. On the fiscal side of things, we've known our problems and how those have contributed to inflation and general cost of living crisis and all that. There is the tone at the top suggesting that we want to be disciplined this time round. I am praying it's not a 2025 thing in response to the difficulties we have, but it's a new lifestyle for our nation, Ghana. And we see that discipline run through the implementation of our programs and policies. And if we are at those levels, we should be gradually correcting the debt problems and then the many other attendant problems that led us to the kind of challenges we've had in recent past.
Yeah, the governor mentions the need to review the monetary policy implementation framework. I'll ask you about that in a bit, but I just wanted to know from you if you think the Monetary Policy Committee has worked effectively in curbing inflation and stabilizing the city. As surmised from your earlier submission, that you think they're doing a good job?
Well, yes, I mean, and it started way back, right? I mean, if I hear arguments about the efficiency of the monetary policy inflation targeting regime and whether it's working, sometimes I question what the context is and all that. I mean, from inception, when we started inflation targeting till now, we've seen tangible results. The results of 54%, I think, in 2022 and thereabout in inflation was a blip, and we've seen how the same inflation targeting regime has brought it back to today 21.2. There are issues that need to be dealt with to improve the efficiency and transmission of the policy decisions. And to a large extent, I feel gradually we are getting there. And you look at the new changes that have come with this administration, they are giving us, if you like, introductory comment ahead of the MPC. It gives us room to analyze what the major issues the MPC is confronted with, what their decisions are going to look like, and what the conversation points are. We get a clear sense of that. They do not only give us the MPC press release also, but they give us reasoning for each of the members and what they are thinking. We can subject those to analytics and then extrapolate into the future to get a sense of where it's going to go if this happens, if that happens. That brings transparency, predictability to their operation. And you need to take that, and that is the important thing they are doing about the cash reserve ratio and how it's linked to LD. You need to disaggregate that and then ensure that you are using a transparent tool that everybody can see, the monetary policy OMO, to mop up excess liquidity, and then people can predict what is going to happen if there is this level of liquidity in the system and all that. So those tweaks and turns would perfect the inflation targeting regime, and that is what would deliver for us the inflation targets that we so desire. So there has been good work in the past, and the additions to it currently also speak good for us, and really, and that is something they must anchor. That commitment to mop up excess liquidity, no matter what the implication is, and to anchor inflation is recommendable. The governor didn't need to, or they didn't need to raise policy rate at the last meeting. Everybody expected they hold the rate, but they hold the view that they need to correct some of the policy missteps in the past. And the result has been that, contrary to expectation that inflation will pick up a bit in the first quarter before decelerating from April, we've seen for the last 5 months inflation decelerate, and the rate is going to, or the pace for decline is going to get steeper in the coming months, really. That is a good work of monetary policy showing there, complemented by fiscal policy and other structural changes that are happening. And long may it continue, in my humble view.
Yeah, what's the verdict going to be, Courage? What do you think the committee is going to decide on? Would they want to tighten monetary policy in response to the risks the governor mentions?
Well, I think at this point, it will be too early to cut a rate, despite the declines in inflation we've seen. Inflation now 21.2, with monetary policy at 28. You have a real policy rate of above 7%, which I think is what those levels is what we've seen in the peak years of Addison, when we try to keep inflation within check. It was at a point around real policy rate around 8% thereabout. If you go by that thinking, the fact that inflation is on the downtrend, I think this window would keep the policy rate at 28%. To one, signal the intent to sustainably bring inflation down. If we had this comment yesterday, yes, 21.2 is good progress, but it's still very high relative to what our target is and all that. And they will need to keep that, if you like, guidance to the market that they intend to keep it down. They would also want to keep it down so that at least they keep it at the level to ensure that real policy rate get to a level they are very comfortable with. And then you might see a more significant cut maybe from July, when they meet in July, by which time inflation would have receded sufficiently and make enough room for a more significant cut. So I see them holding their rate. But what they will likely do at this decision, this meeting, will be to decouple the current cash reserve ratio from the loan deposit ratio. And he hinted that in his opening address, really. What it does is there is a huge stock of liquidity cash that is kept at the central bank and unremunerated. Those that deposit bank have gathered, and they have to reserve on them because of the linking of, or the dynamic reserve ratio that links CR to deposits. If you delink that, and even giving the liquidity conditions and the impact on BoG's balance sheet, you decide to maybe even increase the cash reserve ratio a bit higher from where it was before we move into the dynamic, maybe into one of the three rates we are playing within now, it will still have made sense. And then taking away the risk-taking, the motivation for risk-taking from having to advance more loan to come to the lower tiers of the CRL bracket, and it will make monetary policy a bit more predictable. So those are the things I expect them to do at this decision: hold the policy rate at 28 and decouple the CR from LD. What the new CR level will be, I'm not too sure, but I expect, given the liquidity conditions, that maybe they peg it around the middle of the three tiers we have now, around 20% in my view. That's what I expect at this policy meeting.
Yeah, I guess in a couple of days we'll know the verdict. Thank you so much, Courage Buti, Manager, Macroeconomic Research, GCB Bank PLC. Appreciate your insight as always. The Ghana Stock Exchange Index recorded over 30% growth in the first quarter of the year, beating its competitors in the West African sub-region as the best securities market. Managing Director Abna Moah has revealed this. Now, she attributes the feat to renewed confidence in the market and an uptick in activities by investors on the bourse. She's hopeful the growth will surpass other markets across the continent by close of the year.
Market so far this year. As of May 18th, the GSE equities market has recorded a very strong performance. Our index was up over 30%, the best in West Africa. Our financial stock index is also up about 33%. And there's renewed investor confidence and robust market activity. Our market capitalization at over 143 billion Ghana cedis is a growth of over 70% compared to the same period last year, but it's still paltry compared to our GDP. We are looking at a market capitalization of only 5% of our GDP. This number should be about 30% where we stand in Ghana. On our fixed income market, volume achieved or traded so far is about 87 billion versus 57 billion at the same time last year, up about 53%. And so there's progress being made here.
All right, so joining me with a conversation on the stock market boom, Patrick Edemagama, Head of Trade and Republic Securities. Good afternoon to you, Patrick. So what key sectors or stocks contributed most to the stock exchange's impressive Q1 growth?
So far, about 8 of them are financial institutions. You know, this market is largely driven by financial stocks. We've seen it in the past where in 2017, the market hit 52.7%. And it was the banking stocks that drove this. So there is a renewed interest in these stocks. You know, they've been depressed based on the domestic debt exchange. So they are kind of recouping now, and we can see that happening at the top of the league.
Some macroeconomic or policy changes that affected investor confidence in the stock market?
Well, we can say that there is macroeconomic stability that we've seen for the first quarter of the year, and that is also bringing some foreign investors into the market. We've seen for a stock like ETI, we have some people even moving from Nigerian market to sell in this market because ETI has jumped about 190% year to date. So with this stability coming in, it makes investors more confident. We can also see that there are strong corporate earnings coming up with regards to the first quarter performance, and that is also interesting to investors and fund managers.
Is this sustainable?
Yes, we've seen this. If you look at what happened last year, you know, last year closed at 56.17, and we saw this same trend last year where the non-bank stocks like MTN, Benzo or Palm leading the market and driving the market. So now that we have the stocks that actually lead the market, which are the banking stocks coming in, we expect this to continue to the end of the year.
What risks should we look out for
that
could stop this momentum?
Please come again.
I mean, that could hamper this momentum we're seeing.
Well, we are saying that, you know, a lot of Ghanaian investors look at dividend. And as we are seeing, just some few companies have declared dividends so far. If investors don't receive dividend from these banking stocks, it can derail the progress we are seeing. We know that there has been some embargo on payment of dividends, so the banks need to make a case to be able to pay dividends. So investors are looking at this opportunity.
Yeah. Also, I'm wondering what trends you are seeing in investor behavior that is supporting the continued growth that we are seeing with regards to the participation of retail investors. Also, what role is the institutional investors playing in this growth that we are seeing?
Well, for institutional investors, we've seen that there was a shift from fixed income investing to the equities market. Because we are seeing the rates drop in the fixed income market, and that is very usual for institutional investors. They want to really rebalance their portfolio, and those equity funds that were heavily invested in bonds are also coming back into the market to buy equities. I mean, they are already having scheme particulars designed to be equity funds. So they are now restructuring their portfolios, buying more equities instead of investing heavily in bonds and bills. So this trend is continuing, and I think that is going to propel the market to a different level.
Yeah, we seem very positive about it. So what's the outlook, for the coming months?
Well, we expect the trend to continue. There is a lot of bids on the market. We don't have offers. It means people are not selling. And when people are not selling, there's shortage in supply compared to the increase in demand. The price will have to go up. So we expect this trend to continue, especially in banking and financial stocks. Another security to look at is the new gold ETF. It tracks the gold price, and we are seeing the volatility in the international market. So we expect that to also come here. The CCD appreciation also can make a security like the new gold also lose value because it's also pegged in the dollar. So we are studying all these trends to see how that will benefit investors.
All right, Patrick Edemagama, Head of Trade in Republic Securities. Thank you, sir. All right, you're watching The Marketplace. Quick break, we'll be right back. Thanks for being good company. This is The Marketplace. More news on our website, myjoyonline.com/business. Ghana Stock Exchange records over 30% growth in 2025. Q1 best securities market in West Africa. Also, T-bills auction, government to borrow 5.55 billion Ghana cedis on May 23, 2025. We'll bring you that story on Business Live. Don't miss it. My name is Darryl Kwao. Thanks for watching. We will be back same time tomorrow. We're leaving you with our international summaries.